Let me be clear from the start. If you think 2026 is just 2025 plus 1 year, you are already positioning correctly. Because 2025 did not end with a soft landing. It ended with a regime shift. The real story of 2025 is not AI, right? It was not earnings growth. It was not productivity miracles. The real story for 2025 was dollar devaluation. And once you can see that clearly, everything else in this playbook falls into place. This is about surviving a macro transition that only happens once every few decades. So we're taking a look at Ray Dalio's 2026 playbook. And the theme is that the regime has changed. So what actually happened in 2025? Let's take a look at what happened. But basically, the US dollar weakened meaningfully. US assets underperformed globally. Gold surged by 65%. And the S&P underperformed Europe by roughly 23%. So this was not a great year for the US or for the dollar. So that is not noise. And maybe you can understand what's going on right now with the US and all the activities that are going on from a global point of view as well. So that is not noise. That is capital voting with its feet. Now, here's a statistic that should stop you cold. Expected equity returns going forward, 4.7%. Bond yield, 4.9%. That means negative equity risk premium. Historically, that almost never ends well. Right? When stocks offer less return than bonds, you are not being compensated for the volatility. You are not being compensated for the risk. You are not being compensated for the uncertainty. That is not bullish. That is late cycle fragility. There's simply not much juice left to squeeze. So why is this a Dalio-style moment? Well, Ray Dalio has always emphasized one thing. Big cycles don't repeat exactly, but they rhyme. What we are seeing now rhymes with late 1960s, late 1970s, early 2000, post 1945 as well. So debt saturation, fiscal dominance, geopolitical fragmentation, currency debasement. And when those forces converge, capital does three things. One, it leaves overvalued financial assets, selling basically. It moves outside the reserve currency, the dollar, and it seeks hard liquid stores of value. Have you seen gold and silver lately? That is the blueprint. So from the buy side perspective, where capital flows next? Gold and miners, highest conviction. Let's start where this playbook has zero ambiguity. Gold is not a trade. Gold is a monetary insurance. When debt grows faster than GDP, when governments choose inflation over default, when currencies are weaponized geopolitically, can you say Russia? Gold wins. This is not about CPI hedging. This is about trust erosion. The reason we're mentioning CPI hedging, i.e. inflation, because historically we said, hey, buy gold in order to protect yourself from inflation. That is not the view anymore. The view is more buy gold because financial assets are probably not on their way out and on their way up. So be careful. So this is not trust erosion. Gold does not default. Gold does not dilute. Gold does not depend on policy credibility. That is why it's listed as highest conviction by Ray Dalio. Miners amplify that trend, especially when margins expand during monetary stress. I had made a proposal to my Patreon members on a stock, a gold stock, which happened to also be investing in rare earth mineral. I think the stock was up like 75, 100% in a couple of months. Okay, I sold everything because I am concerned right now. But anyway, more to that in my Patreon channel. But more important, Ray Dalio. Capital already told you the answer in 2025. Non-U.S. equities outperformed the U.S. by 10 to 23%. That is not coincidence. It reflects, one, lower valuations, less AI narrative excess, different monetary trajectories. Trends don't reverse simply because people notice them. They reverse when positioning saturates. But we're not there yet. How about emerging markets? The deglobalization beneficiary. Emerging markets, and listen to me on that one, gained 34% in 2025. Why? Well, because deglobalization does not mean isolation. It means regionalization. Supply chains are being rewritten. Trade blocks are hardening. Capital is flowing toward commodity-linked economies, manufacturing hubs, and energy exporters. This is structural, not cyclical. Defense. Follow the spending. Global military spending is not slowing, it is accelerating. Defense is no longer the defense is basically no longer discretionary. It is political necessity, as we could see in the news every day. That makes sense, right? Every geopolitical fracture becomes a budget line item. That makes defense one of the few sectors with guaranteed demand, government backing, and long-duration contracts. How about U.S. manufacturing? Well, direct capitalism is back. Forget free markets. What we are witnessing is government-directed capitalism, reshoring, industrial policy, strategic subsidy. This is not ideological. It is reactive, and capital follows incentives. Energy. Politics matter. Energy is political again. Supply discipline, strategic reserves, regulatory shift. Energy is not about ESG narratives anymore. It's about national security. Now, the avoid list where losses hide. U.S. large cap tech, overvaluation risk, warning, negative risk premium, crowded positioning, AI optimism priced to perfection, as I've done in several other of my videos. This is not anti-technology, it's just valuation reality. It's too expensive, right? When you've got stuff like a Tesla at 150 plus PE, great companies can still be terrible investments at the wrong price. NVIDIA. Long duration bonds, the silent killer. Here's the math nobody wants to discuss. Massive treasury rollover, yield curve steepening, fiscal dominance. That combination equals duration pain. Now, illiquid assets. Liquidity always wins. Private equity, commercial real estate, illiquid credit. These assets work until they don't. When liquidity dries up, valuation gap down, redemption for selling, correlation go to 1. This is where forced seller lived. There's no liquidity, there's no private equity, there's no commercial real estate. Next, USD cash, the hidden tax. Holding cash feels safe. But in a debasement regime, cash is a slow bleed. You don't lose nominally, you lose purchasing power. The real risk ahead, i.e., let's talk about what we can break this playbook. Political chaos between 2026 and 2028. Margin compression from rising costs. Interest rate surprises. You are going to lower rates, right? Disorderly unwinds in illiquid markets. None of these are tail risks. These are base case risks. So, in conclusion, what's the bottom line here? Well, this is not a stock market cycle. This is a regime change. The rules that work from 2009 to like 2021 are gone. The new rules are simple. Diversify away from the U.S. 2. Overweight gold. 3. Favor liquidity over leverage. And 4. Avoid narrative-driven overvaluation. History does not reward comfort. It rewards adaptation. Position accordingly.